In most trading tutorials, you're told to buy when a fast-moving average crosses a slow one, but the data tells a different story. In isolation, traditional moving average crossovers fail more than half the time, trapping retail traders in false breakouts. A single moving average is essentially blind to the broader market context. But when you stack multiple moving averages into a specific sequence, you stop looking at isolated signals and start seeing a highly accurate topographical map of institutional bias. We do this by building a 6 EMA matrix. This framework relies on the 5, 9, 20, 50, 100, and 200 period exponential moving averages. Why exponential moving averages instead of simple moving averages? An SMA treats every data point over the last 200 days equally. An EMA mathematically weights recent price action more heavily. It reacts instantly to sudden shifts in momentum, making it the superior tool for algorithmic trend capture. Over the next 10 minutes, we are going to construct this structural matrix from the ground up, assigning a specific job to each line to establish precise mechanical buy and sell protocols. The 6 EMA matrix operates as a multi-stage verification protocol, quantifying market regimes to filter out the noise that often traps amateur traders. The 200 period EMA represents nearly a full year of trading data, acting as the ultimate arbiter of market direction. This establishes the most unbreakable rule of the matrix. If the price is above this line, you only look for long setups. If below it, only shorts. We then layer in the 100 period EMA as the secondary structural filter. This line confirms the medium-term institutional sentiment. By tracking the relationship between just these two lines, you can identify a macro trend change months before retail traders recognize the shift. When the 100 crosses and stays above the 200, the baseline regime has completely shifted. Ignoring the 100 and 200 EMAs is the mathematical equivalent of swimming against a riptide. Together, they dictate the dominant institutional flow. With the macro direction set, we zoom in to evaluate the active trend using the 50 period EMA. This line is the primary gauge of immediate trend strength and institutional support. The angle of this line is critical. A rising 50 EMA signals a bullish environment, a falling slope indicates bearish control, and a flat 50 EMA means the market is consolidating and largely untradeable. Next, we add the 20 period EMA. In a healthy, active trend, this acts as the mean reversion line. Price will frequently snap back to the 20 EMA before continuing its broader move. The space between the 20 and 50 EMAs creates the structural value zone. Amateurs buy at the peak of the move, but professionals wait for the retrace into this zone, allowing for a tight stop loss and a high mathematical advantage. The 20 and 50 EMAs do not tell you exactly when to execute a trade, but they isolate exactly where the highest probability entries exist. Now we move to the microstructure of the chart to determine our timing. We introduce the 9 period EMA as the immediate momentum gauge. Notice how tightly the yellow 9 EMA weaves with the price. When price dips into our value zone, a crossover of the 9 EMA back over the 20 EMA provides the first major confirmation that trend momentum has returned. Finally, we apply the 5 period EMA. This is the ultra-fast trigger line, designed to provide the earliest possible entry signal the moment that upward momentum is confirmed. The 5 and 9 EMAs serve as the surgical scalpel of the matrix. They allow traders to execute entries with absolute precision and minimum drawdown inside the larger macro trend. With all 6 lines active, we have what is known as the 6 EMA ribbon. The physical alignment of this ribbon visually defines the current market regime, separating tradable trends from toxic chop. When market momentum dies, the ribbon enters a state of compression. The 6 lines tangle and weave horizontally, forming a chaotic, tight knot.
Executing trades based on moving average crossovers during ribbon compression guarantees false signals and whipsaws. The market lacks directional volume, rendering traditional trigger signals useless. Conversely, when a trend accelerates, the ribbon enters expansion. The lines fan out in perfect chronological alignment, from the 5 period on top, down sequentially through the 9, 20, 50, 100, and finally the 200. This perfect expansion mathematically proves that institutional volume is driving the trend in one direction across every single timeframe, from the micro to the macro. Knowing when not to trade during compression is the single most important skill the 6 EMA matrix provides. It preserves your capital for the high-probability expansion phases. Let's turn this theory into a strict execution protocol, starting with the long setup. Step 1. Verify the macro regime is completely bullish. Price must be above the 200 EMA and the 200 must be sloping upward. Step 2. Wait for the price to retrace downward into the 20 or 50 EMA value zone. Remember, we do not buy the initial breakout, we buy the structural pullback. Step 3. Trigger the entry only when the 9 crosses above the 20 and the 5 crosses above the 9. This confirms momentum is back online and reestablishes perfect ribbon expansion. The protocol for a short setup simply inverts these rules. You confirm the price is below a downward sloping 200 EMA, and you wait for a short-term rally up into the value zone. Short executions often require speed. Notice how the relationship between the 5 and 20 EMA acts as a sensitive tripwire, triggering sudden downside momentum exactly as the relief rally fails. One final non-negotiable rule exists for all setups: the candle close confirmation. You must wait for the physical candlestick to lock in its closing price. Executing a trade on a crossover before a candle formally closes is a fatal error. Intraday volatility can cause the moving averages to cross back and forth, completely erasing the signal by the time the period actually ends. Treating these steps as a rigid binary checklist completely removes emotion, fear of missing out, and hesitation from your trading process. Either the matrix aligns or it doesn't. To further prevent overtrading, we have to deconstruct how different crossovers carry different weights. The 5 crossing the 9 offers the absolute earliest momentum signal, but it carries the highest risk of false positives in choppy markets. The 20 crossing the 50 is much heavier. It defines the confirmation of a medium-term structural shift, making it the ideal signal for initiating swing trades that last for days or weeks. Then there is the rare 100 crossing the 200. This is a major macro transition signal. It dictates multi-month portfolio shifts and massive institutional reallocation. To mitigate whipsaws across any of these signals, apply this filter. No crossover is valid unless the slope of the 50-period EMA agrees with the direction of your intended trade. Not all crossovers are created equal. Their mathematical validity is entirely dependent on which layer of the matrix they occur in and whether the broader structure supports the move. Let's lock in the hierarchy. You use the 200 for absolute direction, the 100 for macro structure, the 50 for trend strength, the 20 to locate pullbacks, the 9 to read momentum, and the 5 to pull the trigger. Remember the lethal mistakes that destroy retail accounts. Never fight the 200 EMA, never buy overextended breakouts far from the 20 EMA, and never execute trades during ribbon compression. The golden rule of the matrix is simple. The macro trend tells you exactly where to trade. The micro crossover tells you when momentum has returned, and the final candle close tells you when to execute. This approach replaces predictive guesswork with reactive probability and institutional alignment. You wait for the market to reveal its hand, then execute based on the alignment of the matrix.